companies can either pass it on or not. And I think they're going to find it hard to pass it on. And I think that's going to squeeze margins next year. So I do think that whether we have a recession or not, we could end up with negative earnings growth next year.
David, like everyone out there, on my cell phone, I have a real estate dump of whatever geography I'm looking at. Doesn't everybody go out today and mark down the price of their house for sale?
Yes, and it takes a long, long time for that market to clear. But the reality is the average mortgage payment on a new home has gone up by 60% in the last year. And that one I do really blame the Federal Reserve for. They kept rates so low for so long that it caused a in prices, and now we can't deal with it. I don't think there's enough people to buy homes when you push the average mortgage rate or average mortgage payment up by 60% in a year.
John, I think this is just absolutely profound. I can't say enough about sector to sector in inflation, the different elasticities that are out there on home ownership and how it redounds over to rent multifamily nationwide. Every region's different. Guess what? This report is a game changer.
Core inflation came in hotter than expected, and shelters are one of the most stickiest part of the report when it comes to inflation. And David, I appreciate what you're saying, that things might be getting better, perhaps not worse. But when you think about what the Fed will do, not what they should do, David, can you talk to me about what you expect they will do? They've laid out their reaction function. They've told us how they'll respond to incoming information. Tell us what you think that means for what they will do.
Well, I think what they'll do is they'll go 75 basis points next week, but I do think that in the press conference and perhaps in the statement, they will acknowledge the fact that inflation has cooled somewhat, but they'll say, 2 data points are not good enough to call it a trend yet. So they'll have some caution there, but they'll put enough doubt in there to give them the space to only go 50 basis points in November. So I think they want to set it up that way. They want to put in a hawkish move, but to give themselves the opportunity then to put in more dovish language without being labeled as being soft on inflation. But again, I would focus on this shelter thing. Yeah, it's a long lagging problem in inflation. But if you think about it, how does higher interest rates help deal with a shelter inflation problem? I mean, if it stops people from building houses, how are you going to bring down rents? So it's
that's the problem.
The one thing that they're most worried about, or the one thing that's keeping inflation high, is the thing that they can fix the least by pushing up interest rates.
There you go.
David Kelly of JP Morgan Asset Management is going to be sticking with us. Perhaps that's a question, Lisa, for the news conference next week. At the end of the day, they've told us the data they'll respond to. This is it. It's hotter than expected. Until they turn around and say, yes, but this is the part of the inflation report that we can't really do much about, so we're not going to do anything. That's not where we're at. That's not what they're saying.
And that's the reason why people are starting to price in a higher likelihood of a 75 basis point rate hike in November, beyond the September meeting. And this really speaks to what the Fed is probably going to signal, which is everything's still on the table. It's not coming down.
I would note in the last 20 minutes, the Bloomberg Financial Conditions Index has shown a more accommodative statistic. It's screaming that we need more rate rises out into the future.
The S&P right now is negative 2% on the Nasdaq 100. We're down 3 percentage points. We're about 12 minutes into the session. Yields are much, much higher. We had the pushback from the Federal Reserve after the rally of June into July, from mid-June into July and onto August. And then I think we're all preparing for the pushback again at next week's meeting after the rally of the previous week or so.
Maybe in their silence, the market will start to hear the tea leaves they've been putting out there. I mean, that seems to be where we're at right now, because it seems like they won't have to guide the market anywhere if today's whole moves.
Well, that's the whole point of setting out a very clearly communicated reaction function.
Yeah.
It's that you shouldn't be out there talking all the time. You just have to lay it out and say, this is it. This is how we respond to incoming information. What did Jonathan Gold of Credit Suisse say?
Oh, that it's game theory. I think it was something that basically they can't say that they're not going to hike rates, because then the market will become accommodative and then they won't change their goal. Yes, Tom?
If Sterling goes through 114, 3-bedroom, 4-bath, Beaufort Gardens, Knightbridge.
Oh, nice.
Like $16 million.
Are we sharing that?
I think, yeah, you and
You're paying and, okay.
You're staying.
Are we on separate floors?
Of course.
Good.
By definition, it's a walk-up.
Equities down 3% on the Nasdaq 100. That's an expensive kind of walk-up, Tom. On the S&P 500, we're down more than 2%. The conversation continues. This is Bloomberg.
We're seeing hopeful signs of progress on inflation as well. The price of gas, when we said what I was doing wouldn't make any difference, and guess what? It's down $1.30 since the start of the summer and continues to go down. Inflation eased in July. I said last spring that our top economic priority was to bring down inflation without giving up on all the gains American workers made last year. But there's more to do.
There's more to do, that's for sure. That was yesterday. We'll hear from the President a little bit later this afternoon after a hot CPI print. I'm sure that David Kelly disagrees with that over at JP Morgan, but most people calling this a hot CPI print in the United States of America. 20 minutes into the session, equities lower by 2% on the S&P. On the Nasdaq, we are lower by more than 3 percentage points. AMH down in DC. Anne-Marie, we hear from the President, I believe, at 3 p.m. Eastern Time.
Yeah, that's right. And he's going to be talking about the, quote, Inflation Reduction Act. And we have a time when inflation, as you say, Jonathan, and most of the street believes, is hot right now. And it did come in worse than what was expected. And what the president has been leaning into, as you just heard him just yesterday talking about the fact that they are seeing inflation starting to quell, he's trying to lean into some of these better economic data points. The one bright spot in this report that the White House is certainly going to spin, similar to what the president said yesterday, is the fact that gasoline was above $5 a gallon in June, and right now it's hovering around $3.70. This is good news for this administration. Just last week, we had the biggest drawdown selling in the SPR since the SPR came into fruition, since we had one in its history. So this is the work they've been doing. But at the same time, how much is he really going to be able to sell this point when you have core inflation higher, when you have food higher, when you have rents higher, and the timing couldn't be worse because obviously we're less than 2 months away from the midterm elections. Well, and we have seen 90 consecutive days of declining gasoline prices, which really is the heart of what you're talking about, Anne-Marie. But how much further can they really go? Because we were talking earlier with Regina Meyer of KPMG, and she was saying, you know, talking to how low the inventories have gotten and that they've got to start rebuilding, which will probably create the opposite effect. Yeah, I was listening to that interview, and what her concerns are is what I'm hearing from a lot of people in the industry, which is also we need to start refilling the SPR. So that could also be good for U.S. oil companies. But I think a big question about that is at what price is the U.S. going to be willing to start buying oil, right? They would want to obviously try to fill it up at a much cheaper price. And the other big question, of course, is that this SPR release they have, and it's been a slow drip in terms of how they do the drawdowns, but it ends in October. So there's a big question of, do they slow it down into the winter, or is there going to be a potential another tap of it?
Anne-Marie Horton, thank you so much from the White House lawn this morning. On Bloomberg Radio and Bloomberg Television, we continue with David Kelly of JP Morgan. David, I want to go to my chart of the year, which is a comparison of Japan, Europe, and U.S. animal spirit, the nominal GDP. If we get a slower disinflation, if we get an elevated disinflation, how does that change the difference between real GDP and that inflation component? What does that mean for the businesses of America?
Well, I think both are going to come down. We're going to get a revision actually to the last 5 years of GDP data. We're going to get that at the end of this month, and it could take away one of the negative quarters we got earlier on this year. So I think growth might have been a little stronger at the start of this year, but it is slowing down. And so we're, I think over the next year, next 12 months, we'll be lucky to get 2% real GDP growth. I'd say closer to 1%, maybe add on another 3% for the GDP deflator. So you're talking about 4 to maybe a little over 4% nominal GDP growth. That's a lot less than we've been seeing, particularly in the last year. So nominal GDP growth is slowing down. What that means is lower revenue growth for companies, and that is going to be tough for companies to deal with.
Yep.
And that's why we're seeing a lot of revenue and earnings downgrades. And we just had a note from Jonathan Golub over Credit Suisse come out and track those downgrades and how they've come in at an accelerating pace. He's still bullish. You've expressed optimism consistently, and I think that this is interesting. What's going to be, and I hate to use this word, but the pivot point for market participants to get more confidence in a rally that is not loved and clearly is quick to reverse on a day like today?
Well, I think at some stage the Federal Reserve will feel comfortable enough with the progress we're seeing on inflation and scared enough about what's going on with the economy that they'll signal that their next move is going to be less dramatic than the last move. And as soon as we go from a 75 basis point rise to a 50 basis point rise, then people will begin to figure out that this is, that the Fed's going to have to turn here. But longer term, do you think that this economy can actually operate with a federal funds rate above 4%? Because I don't. I think that longer term there just isn't enough demand in this economy after years of very low interest rates. I think that this level of the dollar, this level of mortgage rates, they will tend to slow this economy down. So I think the Federal Reserve is going to have a very hard time holding the federal funds rate above 4% if they decide to push it there. And that's something else they have to think about. They don't want to be cutting rates next year. The market's actually pricing that in, that they're going to overshoot and have to cut. They don't want to do that, but if they go too high, then they'll have to cut next year to stop the economy from going into recession.
David Kelly, I've got one final question. You said this was an overreaction. If it is, what would you buy right now?
I would. I think I would be a little short the U.S. dollar right now. I think the dollar is surging too much in this, and I think I would be buying financials and probably tech. I think that if long rates come down a little bit because people figure the Fed's eventually going to crack here, then I'd want to get ahead of that trade.
David Kelly, thank you, of JP Morgan Asset Management. Just leading the other way, Tom. We like that, a different view.
It was a different
With an equity
view,
market
absolutely.
down 3% on the NASDAQ and down 2% on the S&P.
That was a trot down a small street in Boston from 40 years ago of David Kelly at Putnam years ago, and down the road was the legend Phil Correa of Pioneer Funds. And David channeled Mr. Correa, and trust me, John, it was Mr. Correa, where he talked about declining revenue growth given this cycle. That's what I'm watching for into earnings season into next year. The world changes when you move away from the bright lights of inflation, to borrow from Phil Correa.
An equity market that's softer, and Lisa, we've got to talk about a bond market that's softer too. Yields are much, much higher, 2s, 10s and 30s. This is quite a move off the back of this inflation report on a 2-year. Now you can say the equity market perhaps not an overreaction because we were up 5% over the last 4 days, so maybe we're taking some of the heat out of that move. But see yields up 17 basis points on a 2-year, 373, 92 on a 2-year yield in America.
The highest level going back to November of 2007. What's coming clear is that the debate is about whether this economy can withstand 4% interest rates for long enough. And that might be one of the big, that might be one of the big dividers between bulls and bears, because people might be able to say the Fed can hold them there for longer than perhaps you think. And that is a bearish case. The bullish case is no, they can't, and they'll have to reverse course very quickly.
I think you framed that debate perfectly, not just today, but over the last several months, Lisa. Can we just say thank you to the team again for putting together this beautiful set with this absolutely beautiful backdrop here in London. We'll be here through the rest of the week. We will be here tomorrow as well.
Am I here tomorrow?
And we'll see if this equity market move sticks. You're supposed to be, Tom. On the S&P, we're down 2%. On the NASDAQ 100, we're negative 3 full percentage points. Live from a beautiful London for our audience worldwide. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, September 13th. Here are the top market stories that we're following for you at this hour. Prices just too hot to handle. Inflation jumps higher in a surprise reading that showed an increase in everything from shelter to medical care to goods. And that leads to jumbo hikes. The market's fully priced in a 75 basis point hike from the Fed next week and increases the terminal rate. We're going to look at the likelihood of 100. So just forget about risk today. Get out your safety playbook. Equities and bonds hit hard. The dollar surges. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And an uncomfortable statement from the White House, Guy, talking about how, yep, inflation, we're going to bring it down. It's going to take time. This is not the print that the president would want to have seen.
Yeah, this is not the print that the president certainly was looking for here, was it? This is going to be good news for the Republicans. They'll be able to use this into the midterms. The president has got to put some spin on it. He is certainly doing so in this statement. It will take more time and resolve to bring inflation down, which is why we passed the Inflation Reduction Act to lower the cost of healthcare, prescription drugs and energy. A lot more wood to chop on that front then. This is an inflation number, Alex, that is ugly, ugly, ugly. The president's trying to put a spin on it that is positive. The market, not so much.
No, because it's not going to help rents. Rents is one of the biggest problems there. And also you can make the argument that in terms of markets, we were already sort of priced for something lower. We were priced for something good. Therefore, there's a lot of position readjusting right now within the equity market and the bond market.
Absolutely. The equity market, I think this point was made a little while ago. You can kind of understand the equity market after the rally we've seen over the last few days. But the move at the front end of the curve, the move in the 2 years is pretty sensational here. This is a significant repricing. And you look at what is being priced with the Fed. It is fascinating. So you've got, let's call it 180 bips, circa 180 bips price between now and the year end. And the market is basically looking at 75, 75, 25. But as our question of the day, and as you alluded to in the opening, Alex, do we need to talk about 100? Do we need to now think about 100 basis points at the upcoming Fed meeting? Is the Fed behind the curve? Does it need to take more aggressive action? Well, let's kick this around a little bit. Bloomberg international economics and policy correspondent Mike McKee, as ever, joining us to give us his take, and Bloomberg macro strategist Vince Signorella joining us as well to lean in on this story. Mike, let me start with you. 100. How high is the possibility in your mind, do you think?
Very, very small. I don't see a reason that the Fed needs to do this based on a couple of tenths of the CPI. We knew inflation was up, and we knew inflation was still too high, and the Fed has been fighting that by doing 75 basis points, and they've said that they want to do another significant hike, which everybody's taken as 75. You got to remember how rare these moves are. 75 has only been done in the last 30 years 3 times, and 50 basis points has only been done 4 times. So a Fed that usually goes 25 is now talking about 75 for a 3rd meeting in a row, and then maybe we'll see what happens in November, although there are political implications there. I don't think they are going to see a need to do 100 basis points. They'll still get to the terminal rate they want probably by the end of the year without doing that.
Well, that begs another question on what the terminal rate now should be. But before we get to that, Vince, you literally were laughing at the question. Why?
Yeah, I totally agree with Mike. I mean, 100 basis points would, I think, to me and the market, make the Fed look like or signal the Fed was panicking, and that would just make the situation worse. We still really haven't given the Fed's actions so far, and I think Mike made a very good point at how rare these moves are. We haven't given time for these adjustments in monetary policies really affect the economy and prices. When you look at today's CPI, I would actually argue what the Fed will do next is not going to matter at all. We've got food prices up 13.5%, electricity 15.8%, rent up 6.7%. The higher you raise interest rates, the higher you raise the cost of maintaining rental property. So in effect, the higher they raise rates, the higher they're going to raise CPI. The costs that are rising are out of control of the Fed. Now, I understand the look and that they can't just simply do nothing and let the market markets think that they're beaten, but the matter of the fact is they're beaten. Yep. What's raising prices is out of the Fed's control.
Okay, so 75 and a hawkish statement, is that now more likely? Could it be a more neutral statement? Is that where we see the difference coming, Vince? That actually when we get that statement from the Fed, the press conference, much more hawkish from Powell?
Yeah, I think you make a really good point. I think that's probably the most likely scenario. They've always said that they've wanted to see consecutive months of inflation rolling off before they would capitulate, before they would consider pausing, if you will, not necessarily cutting, but pausing. And they've not seen that yet. So I think that's the point that Powell will probably drive home once again, that inflation is still high. They're not seeing it roll over consistently. Month-over-month numbers are still higher than they would like to see it, so that they need to maintain their vigilance, and that's going to give the market pricing. I would suggest probably another hike in November, although data may not show that that's really necessary, but I think the market will start pricing that.
So, okay, that brings us back to the terminal rate question then. I saw economist after economist, Mike, last week upgrade their terminal rate forecast to the high end of 4.25. Does this change the conversation, this kind of print?
I don't think so. I think the point that Vince made, that we haven't seen the effects of the lagged rate increases, they haven't hit yet, and so the Fed is going to want to wait and see how that begins to affect the economy. Now, they have been in the camp of around 4% plus or minus 25 basis points one way or another for most of them for about a month now, and certainly we're at Jackson Hole. We do get a new dot plot and a new forecast for where the terminal rate is at this meeting. So we will see next week where the Fed thinks they need to go, and that will shape market perceptions about how fast they're going to have to move. I did want to commit one bit of heresy here. I don't know if you have a church door for me to nail this thought to, but the Fed's November meeting is a week, literally a week before the November elections. And if they're doing 75 again in November, then that's going to be read as a really bad sign for Joe Biden. If the Fed doesn't play politics, they'll do what's necessary. I'm not turning in my membership card in the We're Not Political Club, but they will, if they need to look around, see that as perhaps an opportunity to either do less or to hold and see what happens, because it's not that they want one side or the other to win, but they don't want to be seen as influencing the process.
Yeah, that gets very circular very quickly, doesn't it? Particularly as the president said, get it under control, get it sorted. Vince, final question to you. Dollar's on a tear once again. Front-end yields obviously moving aggressively. When does the dollar start to break something, and how does that feed back into the Fed's thinking?
You know, the dollar's its own animal today, and you know what's going to cause the dollar to stop going up is if and when the Fed decides to pause. The U.S. dollar and the U.S. equity market, S&P 500, are very, very tightly inversely correlated, have been since March, and until risk turns and we get a positive risk tone, it's what we saw yesterday. At a positive risk tone, you saw a lower dollar. That's what's going to put a ceiling on the dollar. We just haven't seen it yet, but my gut feeling tells me we're not as far away as people may think.
Wow, I was not expecting this reaction from both of you today on this really hot number when yields are up 16 basis points. But that was a fun conversation, guys. Really appreciate it. Michael McKee and Vincent Signorella from Bloomberg, thank you very much. All right, coming up, our next guest expects the Fed's tightening to be the fastest and sharpest hike that we've seen. Kara Murphy of Kestrel Holdings will be joining us next. This is Bloomberg.
if there's any doubt at all about 75, they're definitely going 75. And we thought they would be stepping it back to November, to 50 in November. And at this point, you would say 75 is certainly going to be on the table there in November.
That was Jay Bryson of Wells Fargo earlier today on Bloomberg Television with his predictions for the Fed's next move next week. Our question of the day, though, is 100 bips. Do we need to consider that right now? Let's ask Cara Murphy, Kestra Investment Management CIO. Cara, what do you think? 100 bips?
I have to agree with your previous guess and say I don't think 100 bips is on the table for the next meeting. But the Fed has to do two things. In coming out with 75 bips at the next meeting, they have to jawbone and convince the market that there is plenty more behind it. The other thing they have to do is raise market expectations for where Fed funds rate is going to be in the second half of next year. The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If that is communicated, if the market listens, what is most mispriced to a more hawkish Fed, do you think, Cara?
Well, I think if we get a much more hawkish Fed, we see downside in both equities and stocks. But I actually think the biggest mistake that I see investors making is avoiding bonds altogether. We've gotten used to a fair amount of volatility within the stock market, but broad bond indexes are down just as much as stocks this year. And in fact, most investors who have a 60-40 portfolio have experienced the worst performance since the 1970s. So there's a lot of pain out there, and there are a lot of people who are questioning sort of in an existential way, should we still be in bonds? So even though I think that the Fed is going to remain quite hawkish, I think it's a mistake to ignore bonds completely.
Where would you be in bonds, though? I mean, just taking a look at the front end today, that 15, 16, 17 basis point move in the 2-year Bank of America's Fund Manager Survey said that one of the most crowded trades was short U.S. Treasuries. Like, where do you want to be in that?
I think you want to be in the middle part of the curve. You don't want to take an excessive amount of risk, because if the Fed wins the war with inflation, they do it by taking a bite out of economic growth. That could impact spreads. So you don't want to be far out on the high yield curve. You want to bring in your credit risk and then have a modest amount of duration.
Just talk me through a bond portfolio as how you would position right now. Say you are not overweight bonds. How would you reposition back into the bond market? You talk about duration. Is it just US bonds? How would you be thinking about credit? How do I manage that side of the ledger in a 60-40 if I am underweight right now?
So again, I would start to leg into the middle part of the curve, focus on duration, and focus on things like treasuries, munis, other types of governments. I think those offer a fair amount of value. They also help buffer a portfolio and do a great job of kind of bringing down volatility. So it's also a matter of the role that they play in a broader portfolio. And then I would wait to leg into things like high yield until we have a little bit more visibility in terms of how much downside we see in the overall economy.
Well, along the same conversation, Cara, Bank of America Fund Manager Survey came out today. We love looking at that. It's a really good read on positioning. It was really bearish, super bearish, quote, was what the survey said. Sentiment depressed. You have 42% of global net investors are underweight, say, European equities. 52% underweight equities altogether. A huge amount is in cash. How do you take advantage of that? Push against it, but also don't fight the tape.
So I think this is a great indicator. I agree. It gives us a real-time view about how fund managers are positioned. And in fact, we've seen an excessive amount of put buying as well, which tells us that institutional investors remain quite negative. But again, to this kind of glass half full side, a lot of this downside in both the economy and higher rates are already baked into markets. So that does tell me that, I think we could have some additional weakness in the near term in both bond and stock markets. But I don't think we're going to see a tremendous amount of downside because people already have a fair amount of cash because sentiment is already fairly negative.
Cara, if I have cash, why shouldn't I stick with it? And how much time am I going to have to figure out what to do with it when things do start to move?
Yeah, it's a great question. And I think looking at how the stock market has performed over the last few weeks is a great example. We started to see the S&P rally before there was any data showing that there was a slowing in CPI. Now, today we had a negative print and some of the air is coming out of the tires, so to speak. But I think the market is probably going to start to bottom before we even have a whole lot of confirmation in the CPI data. And that's why it can be quite dangerous to sit on a big bucket bucket load of cash right now.
So does that mean that the June low was the low for you?
That's a great question. I think it's probably close to the low, if not the actual low.
Are you just sticking with the US? It's interesting to see how Europe is reacting today, not quite so violently. So much bad news priced into the rest of the world. How do I manage that mix as well? The US has got some bad news, probably quite a lot of bad news. The rest of the world's got an awful lot of bad news priced.
Yeah, for sure. And I think if we think on the equity side, the U.S. is farther along in this sort of tightening curve than any of the rest of the developed world, Europe in particular. So if you go back to even pre-COVID, the U.S. Fed started hiking rates earlier. They started withdrawing quantitative stimulus. Pre-COVID, they cut rates and they increased quantitative stimulus early, and now they're raising rates again and withdrawing some liquidity earlier. So what that means is that I think U.S. equity markets are going to be better poised to rebound before places like Europe. There's still a fair amount to be done, but I would also say that, you know, I hear a lot of existential questions about whether or not U.S. investors should be invested overseas, and we still think that they should be. Those play an important role in a portfolio, but we would have a preference for U.S. assets right here.
Okay, last question. Dollar near its peak?
It's been really tough to bet against the dollar. We looked at this recently. The trade-weighted dollar is up 350% since the 1970s, and we've had very, very short periods of downside in the U.S. trade-weighted dollar. That said, mathematically, it's very hard for the U.S. dollar to continue increasing at the pace it will be. So I think we're going to see a softening in the dollar sometime in the future. I don't think it's going to be huge, but it just can't keep at the pace that it's been going.
It's blistering, isn't it? Cara, great to catch you up. Really appreciate the input as ever. Cara Murphy of Kessler Investment Management. Thank you very much indeed. What are we going to be talking about next? President Biden is expected to talk up the economy when he speaks a little later today, despite those worse than expected inflation numbers. It's going to be fascinating to hear what he has to say. We're going to head to the White House next to get an early indication. That's next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ruchika Gupta. UBS plans to raise the dividend for this year by 10%. The Swiss bank also expects share repurchases will exceed a target of $5 billion for 2022. UBS is returning excess capital to investors after calling off the $1.4 billion acquisition of U.S. robo-advisor Wealthfront. Saudi Arabia told OPEC that it raised its crude production to just over 11 million barrels a day last month. That's the first time in 2 years the Saudis exceeded the symbolic level. The kingdom fulfilled its pledge to get production back to where it was before the pandemic. And a Chinese-made single-aisle passenger jet designed to rival Boeing and Airbus could be certified by the nation's regulators this month. That's according to local media. Certification could clear the way for the C919 to start commercial flights some 14 years after development began. And that is your latest business flash. Alex, Guy.
All right, thanks so much, Ritika. So August CPI report, a lot worse than expected. And moments ago, as we mentioned, President Biden came out with a statement saying that it will take more time to bring inflation down. That's ahead of his remarks later today, touting the Inflation Reduction Act. Want to bring in Bloomberg Washington correspondent Emery Hordern. Emery, this was a very big surprise to the market. I can only assume this was a very big surprise print for the White House as well. How does it change what he does later on today?
Well, I think it just changes really the tone and how they try to spin it, and also really whether or not their messaging could stick with the American electorate as we gear up for the midterm elections, now just under 2 months away. We have seen the president over the course of the past few weeks really try to lean into the fact that they are making inroads when it comes to inflation. Most notably, what they'll talk about is the fact that gasoline prices are down. At their peak in June, it was above $5 a gallon. Right now, it's $3.70. But let me bring you a little bit of the start of this statement to give you a sense of what we could expect from the president today at 3 p.m. So he says, today's data shows more progress in bringing global inflation down in the U.S. economy. Overall, prices have been essentially flat in our country that these last 2 months. That is welcome news for American families with more work still to do. So two things really stick out to me. One, it's not an American problem, it's a global problem. And two, it's essentially flat. Is it really? That is the messaging they're going to try to do. And I really think they're going to lean into the one bright spot. And that is just the fact that obviously energy in terms of gasoline is lower. But you look a little bit deeper, electricity prices, natural gas, all of that going up.
Emery, sequence for me the issues that Americans care about going into the midterms and how high on that list is inflation.
It's a great question. I've been looking at some of the polls a little bit more closely, obviously, recently following. Obviously, we have all these primaries. Tonight, we're going to have the final primary in states like New Hampshire. And what is striking to me, following the vote in Kansas on abortion, following the swing district in New York where you had Pat Ryan, the candidate, the Democrat, really lean into abortion, while his opponent was really leaning into the fact that inflation is going to be this problem, Pat Ryan took it away. And this is really as swingy as they can get in New York. This is a district that voted for Bush, Obama, Trump, and Biden. So right now, the recent Wall Street Journal report had what issues would you go out and vote on? And economy led number one, but number two was abortion and women's access to reproductive rights. And number three was inflation. So what's really scaring the Republicans that wanted to make this entire election about the economy, about inflation, is the fact that abortion is really a live issue that we have seen the data points of people going out and voting on.
AMH in D.C., thank you very much indeed. Bloomberg's Emery Hordern outside the White House. Let's talk about what is happening right now in the Senate, also in D.C. You've got the Twitter former security chief, Peter Zatko, Mudge as he's often known, talking to a Senate panel. Alex, it's we're watching this with a great deal of interest, of course. I would have thought there's somebody else that's watching it even more closely.
Mr. Musk. I would say that Mr. Musk is very much watching this as sort of to help his case that he should be let out of the Twitter deal. Certain things that we know is that he says so far that executives focused on profits over security. He has said that in the past as well. He says the FTC is in over its head, and this is all as he tries to explain those claims to the Senate panel. He also goes to say, probably preemptively, I did not make any whistleblower disclosures out of spite. Remember that he was fired supposedly due to poor performance.
It's interesting. Senator Grassley calling for a CEO resignation on the back of this. You don't often see that. You almost never see that. And it's interesting that Agarwal was invited but declined to come to this meeting, to this hearing. So it's getting pretty feisty. And as you say, Elon Musk certainly paying a great deal of attention here to what is happening. This in some ways goes to the heart of what we're talking about in terms of the Twitter case, the Twitter takeover case. Ed Ludlow is going to join us a little bit later on. He'll be talking about this, plus also what's happening, of course, with another very high-profile case that's taking place today, the Nikola trial. Up next, perfume and cosmetics, household furnishings, auto repair. These are some of the items that saw price increases in August. We're going to discuss this next. This is Bloomberg.
All right, we're about an hour into the U.S. trading session. Ugly day just keeps evolving here. The S&P now down a full 2.5 percentage points. Abigail Doolittle is tracking the latest moves for us. Hey, Abigail.
Well, Alex, yes, we do have this pretty steep decline. Now, this is an interesting chart because, of course, going into today's stock decline, we had a big rally. That NASDAQ 100 up about 5%, more than 5% over the last 4 days into today. And now we have this steep decline on the day, down about 3.5%, the worst day in almost 3 weeks. What makes it so interesting, though, yes, it's a little bit hotter than expected. expected. David Kelly of JP Morgan was making this point on surveillance. But if you take a look at the trend, inflation over the last couple prints, it's actually basically lower. You have it coming in June, I think it was somewhere above 9%, then 8.5%, and now at 8.3%. But we have this huge reaction to it. So what we're looking at here is a 100% likelihood that we're going to have a 75 bip raise at the meeting next week by the Fed. But we also have a shot that maybe there will be a 100 bip raise at that meeting. There's a 16% shot of that. So not very likely. If you think this is bad, though, think back to 1981, May of 1981, 400 bips in one meeting. And in 1980, November and December, there was 500 bips of raise between those two meetings. So back then, 3 meetings led to a 9% raise. So the 75 bips, even on top of the others, maybe not so much from a historic standpoint, but it is moving yields in the yield curve and the dollar. Take a look at the Bloomberg dollar, up about 0.75% earlier, up more at that point on pace for its best day since early July. But take a look at this 2-year yield. I mean, it's really incredible. 3.72%, up 16 basis points. You also have this 10-year yield higher. Not surprisingly, then you have the 210 going a little bit more inverted. Now, this dollar strength, it is weighing on the commodity complex. Earlier, you had crude oil up as much as 1.7%, now down about 0.5%. Guy, you can see it's a pretty broad-based sell-off, not to the degree of stocks, but take a look at gold. That haven really not behaving in that way at all. Copper and the Bloomberg Commodity Index overall lower. Today, more risk off than not, even though you have bonds selling off as well.
Absolutely. It's a pretty big move. The bond market move really catching the eye. Abigail, thank you very much indeed. So let's continue this conversation. Let's talk about the inflation print we had today. Certainly worse than expected. This was an August number. It's going to keep the Fed on track. Certainly, this is the market's perception right now for a third 75 basis point hike. Omer Sharif, Inflation Insights founder, joining us now with some insights. What are we learning here, Omer? What was different here in this inflation number, if anything?
Yeah, I would say one or two things in particular. First, we just have not gotten any real relief in terms of goods prices outside of autos. I, along with I think a lot of forecasters, have been looking for things like furniture prices, household supplies, cleaning products, all these things for your house. To really come down, because we know spending is coming off in those categories. But unfortunately, we're just not seeing the price data. Household furnishings were up 1% again today. So that part of the CPI basket is continuing to remain, I think, much stronger than we would have expected, and it's not really helping the core at this stage.
So, Omer, let's take that apart a second, because I thought that once the supply-driven shock was fixed, which to some extent it has been, prices would come down. So my question is this now demand-driven, which could be stickier, or are we just going to see it roll over like next month?
Yeah, that's a great question. I think on the demand side, quite honestly, we've been seeing real spending on furniture come off. We've been seeing inventories, for example, move higher. So it's starting to get to the point where all the big box retailers who were telling you that, look, inventories have piled up, we've got to discount all this stuff. Either it's just not being picked up in the CPI, which is a possibility, and as you say, it could show up next month or the month after. The other part of it is, we could just be seeing continued pass-through of higher wages, higher transportation costs and the like to move some of these things. So that could be part of the story as well.
Omer, you bring up transportation costs, so let's talk about gasoline prices. As gasoline prices come down, is that fueling inflation elsewhere because people have more money in their pockets to spend elsewhere?
Yeah, I don't really necessarily see that in the spending data. I mean, even if you look at, for example, at the second quarter data we had in terms of real spending, that was down a bit from Q1. Q3 is off to a decent start, but it's not clear to me that that's really propelling, excess spending or excess demand in other areas. If anything, we've been seeing overall, retail sales and other components sort of moderate versus where they were last year, for example. So it's not clear to me that that's really what's happening. Again, I think there's just some sort of lagging effect, if you will, of energy, of wages and so on that are passing through into the core. But I do think there's a lot of good signs, import prices coming off, overall energy coming off, ahead, wages cooling as well. But I think we have some relief coming even though we continue to go through sort of a rough patch here on elevated rents.
Okay, but let me do the other side of this. There feels like there's a impending railway strike coming. You already have some railroads preemptively cutting back on passenger and freight service, etc. If this actually happens, how inflationary could that be?
Yeah, the railway strike, I think, I remember reading, I think in Bloomberg story that something like 20% of grains are transported via rail. So clearly that has the potential to have a big impact on food prices, which by the way, today actually cooled just a bit from where we've been over the last several months, which is a good sign. But yeah, that continues to present risk. I think if you go back to the July FOMC minutes, one of the important points from the Fed was, hey, look, it's great that commodity prices are coming down. We're not going to depend on that in terms of the overall inflation outlook moving forward because they could reverse, for some of the reasons that you're discussing.
Omer, do you see any evidence that Fed hikes have had any impact yet on inflation? Policy works with a lag. We're told this all the time, and the Fed needs to be cautious because at some point soon, the effect of this policy is going to work its way into the economy. Where do you stand on that? Where do you think we are on that?
Yeah, unfortunately, I remember years ago, and this is still the case, the San Francisco Fed study showed that only about 40% of inflation is actually cyclical, would react to the business cycle, to what the Fed is doing to influence the business cycle. And most of it is really acyclical inflation that the Fed doesn't have a lot of control over. Where they will start to impact, and again, it is with a lag and it hasn't shown up yet, will eventually be things like rents and home prices. We know those are turning, but the way the CPI is constructed, they will show up with a lag at some point next year. I think the only real place I kind of see it right now is really kind of on autos because financing costs have increased. So you are starting to see some relief there. But it is a little tough to see it really, as sort of a broad-based disinflation that's emanating from the basket, from the CPI basket, due to what the Fed is doing.
Right.
I don't think we're quite there yet.
Right. So to that point, what terminal rate then would be needed and would be necessary to even see inflation start to move towards 2%? Not even at 2%, but to start to slowly move towards it.
Yeah, again, I think there's some of this is disconnected, honestly, from where the terminal rate is going to go. You take a component like medical care, it's the second biggest weight in the CPI. It really is based on administered prices, it's based on private insurance. A lot of this has nothing to do with where the terminal rate is going to be. Ultimately, I think the Fed has a good plan, which is to get to 4%, sit there and see where we end up. And by the way, obviously 75 is locked in, but I think pricing in 75 for November, in my mind, is a bit too premature right now. There's a lot of data between now and then. But I think, this idea of getting to 4, sitting there for at least a few meetings to see what happens to the inflation numbers, in my view, is probably the correct path right now for the Fed.
Omer, is the dollar holding U.S. inflation down? And if so, by how much? The strong dollar.
Yes, we've seen it in import prices that have been coming down quite appreciably. We've seen some relief there, and going back to furniture, import prices for furniture are starting to fall as well. So again, there's a hope that will pass through. And typically there is some pass-through from import prices into what you pay at the store for items like furniture. But again, this was the summer where we were supposed to see the discounting. It has not shown up. And honestly, I think you need to sit back and kind of think a little bit, myself included, about, are we going to get this discounting showing up, even if import prices are coming down or not?
Yeah, and then to that point, if we don't get it, I'm wondering what's leading. Is it inflation expectations leading or the actual inflation number? Because if we don't get that kind of discounting that we were expecting, all of a sudden people are going to start to buy a lot of stuff, and that's going to push up inflation. And I'm wondering the role that expectations are now playing.
Yeah, I'm personally not a huge buyer of the expectations idea. You saw yesterday the New York Fed numbers on 1-year, 3-year expectations. They're basically just tracking what gasoline prices are doing, right? So I don't know how much that's really impacting anything. I think we've been in this high inflationary environment, with basically the entire cost structure to run your business has gone up at the exact same time. Wages, transportation, logistics, everything you can think of that is the cost to run your business has all moved up at the same time. And I think that's the kind of shock that is just sort of working its way, continuing to work its way through the system, unfortunately. We are seeing, again, relief on the supply side. We've seen supplier deliveries come off, import prices are coming down, inventories are building. We may have to wait for wages, honestly, as sort of the leading indicator to see this really kind of moderate going forward.
Cool. Omer, thanks a lot. Super appreciate it. Omer Sharif, Inflation Insights founder. We really appreciate your time today. All right, coming up, lying to investors again and again to make the electric truck company he founded look better than it was. That is what prosecutors told the jury about Nikola founder Trevor Milton, who is on trial this week. We'll be live from the courthouse next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ruchika Gupta. Ukrainian President Volodymyr Zelensky is claiming success for his forces in that counteroffensive. Zelensky says Ukrainian troops have now recaptured more than 2,300 square miles in the east and south of the country this month. But Russian forces have hit Ukraine's energy infrastructure, leaving hundreds of thousands of people in the dark. In Europe, natural gas prices fell for a third day to a 7-week low. The European Union is pushing ahead with its market intervention plan to ease the worst energy crisis in decades. The EU wants to cut power demand and cap excessive revenue of companies producing electricity from sources other than gas. And Deloitte is forecasting that U.S. retailers will see slower sales growth this holiday season because of inflation. The consulting firm expected a 4 to 6% increase in holiday sales. Higher prices are expected to drive more consumers online to search for better deals. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So Trevor Milton, the founder and former executive chair of Nikola, is now on trial in New York. He's charged with lying about the company's products to mislead investors and prop up the stock. Joining us now, Bloomberg's Ed Ludlow is outside the Southern District Courthouse in downtown Manhattan. Ed, I'm looking at a stock. It's a $5 stock. It's a $2 billion company. What's the significance of the founder being on trial right now?
Well, you know, Nikola was the poster child, right, for that wave of EV companies that went public via SPAC 2020 through 2021. You know, I personally, reporting in this sector, hadn't really had any work with SPACs or reported on SPACs until that point. And, you know, the key facet of going public through that mechanism is you can make forward projections or statements about what you think your company will do. And in opening their arguments, the prosecution say that Milton lied again and again and again about all aspects of Nikola's business, the progress it had made on the trucks itself, the hydrogen fuel that it said it was developing and able to produce. In response, the defense is saying he didn't lie. It's a distortion to say that Milton lied, that he believed what he was saying, that in terms of the investors that bought into that stock, all the information was available to them publicly through Nikola's website and documents. And the burden of proof here is on the prosecution, not just to prove that Milton lied. He faces 2 counts of securities fraud, 2 counts of wire fraud. But the prosecution is also going to have to prove that Milton's comments are what motivated or induced investors, particularly retail investors, right, to buy into that stock, which at one point had a market cap greater than Ford despite having 0 revenue.
Ed, why him? Why not the investor relations team? Why not the legal team? Why is he the focus of this case?
Yeah, we expect that to be a part of the defense, right? Communications that Milton had, for example, with Nikola's existing chief legal officer, Britton Worthen. In their opening remarks, the defense pointed out that Milton was part of the marketing strategy, right? He was out there along with the rest of Nikola's executive team trying to talk about what the company was doing. And so, you know, ultimately the prosecution in their opening argument cited our original story from June of 2020, where on an unveil event of 2016, we reported that this key truck that was purported to be a hydrogen truck was missing key components, including the fuel cell that would have made it capable of working using hydrogen. So, you know, what the defense is saying, is that this was a hit job on Milton, that prosecutors are at the heart of this story, and it's because of them, not anything that Milton did wrong, that he was ultimately forced to step down, resign, and the indictments that followed.
All right, let's get to another subject here, very much in your wheelhouse, and that's Twitter. You have Peter Zatko right now in the Senate talking about his whistleblower claims, saying that the company just cannot identify inappropriate access to the platform. He says the company's focused on profits over security. It was not in retaliation that he's making these claims. Significance here.
Yeah, so the significance to the trial, the case that will happen in October between Elon Musk and Twitter is mostly to do with the prevalence of bots. Zatko was speaking about the prevalence of bots on the platform. As you said, he talks very similarly to what we heard in previous hearings about Facebook, for example, that Twitter is a company that prioritized profits over their attention to issues they knew about. That's Zatko's claims. You know, Twitter haven't responded to requests for comment from Bloomberg on this story, but in a memo that Bloomberg obtained from CEO Parag Agrawal to staff, they talk about irregularities and information that's frankly false. And remember that Twitter's lawyers have spoken about Zatko not having any remit in the theater of bots. So in the context of the trial that's to come between Musk and Twitter in Delaware, where it will be decided if his purchase of the company goes through, you know, the judge has already ruled on this issue. She's allowed Musk's team to include some of the whistleblower claim in their evidence and given them a limited ability to gather that evidence. But in truth, Zatko is talking about a wide range of issues here, which extend much broadly to issues of privacy, not just the issue of prevalence of bots, which, as I say, Twitter say are outside or were outside his purview when he was an employee at the company.
Ed, a bunch of companies here that you follow closely, so let's get to the last one. Peloton. Senior management, founding management are off. What does that mean in terms of the strategy and the potential for this company to be taken over or not taken over?
Yeah, it's furious news cycle, right? I mean, the sell-siders point very quickly to the issue of free cash flow, which I thought was interesting. In other words, Foley is a co-founder, right? The chief legal officer who also departed was a co-founder. And I think the logic from the street and the response in the market is this is the last barrier for new CEO Barry McCarthy to get on with his plan to improve cash flow, to downsize the company. There are lots of schools of thought out there. You and I have discussed them, that whether the likes of a Netflix or an Apple buy the company, whatever the case, the street says that they're not interested in the hardware side of this business, which is the focus of Barry McCarthy's downsizing. They're interested in the content and the software. But you look at the stock reaction in Tuesday's trading, and it's seen as a positive because it's just the next step in what is a much bigger plan. And of course, with the founder out the way, it allows for somebody who had influence to be taken out of the picture and changes already planned to take place.
Ed, great stuff. Looking forward to the continued coverage of what is happening in that Nikola trial, and we'll continue to come back to you on that. Bloomberg's Ed Ludlow, Outside Calls. Alex, within the last couple of minutes, we've had some comments coming through from Dan Pinto over at JPM. Kind of feeds into that Goldman Sachs story that we were talking about a day or so ago about the resumption of layoffs. Daniel Pinto talking at the Barclays conference, talking about the fact that third quarter investment banking fees could be down 40 to 50% year over year. JPM was down already. It's continuing to fall.
Yeah, it feels like it's dropping like a stone. And this also really sets up the conversation for any kind of job cuts to these big banks. We heard yesterday that Goldman Sachs is considering some for their deal-making unit. Some of this is normal. Some of this is abnormal. We don't know which is what yet. We'll definitely break down some of that as we go on over the next couple hours. Stock down by about 3.4%. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. The debut of a family-friendly online shooter game sent shares of Nintendo up 5.5% today in Tokyo. It's the biggest jump since December 2020. Splatoon 3's opening weekend set a new high for domestic sales. The Switch game sold 3.45 million units in Japan. There's a leadership shake-up at Peloton. Executive chairman and co-founder John Foley is leaving, and so is another co-founder, Chief Legal Officer Hisao Kushi. That extends the turbulence at the fitness company, which is trying to pull out of a deep slump. And hundreds of New York Times employees are working from home this week in defiance of the company's return to office push. More than 1,200 unionized employees pledged not to return to the office. They're trying to get the Times to negotiate over in-person work mandates and to agree on a new contract. The Times says it has offered a new wage proposal. And that is your latest business flash. Guy.
Rika, thank you very much indeed. Let's talk about where European markets are as they head into the close. Down, but not as much as over in the United States. Equity markets are being hammered and hammered hard, particularly the Nasdaq stateside. We're not seeing that over here in Europe. We're down by around 1.4%. The simple reason for this, Europe's already been smashed and smashed lower. A lot of the bad news obviously is already in the price here, so we're not getting as big a kind of market reaction to that CPI print over in the States. Where you are continuing to get a big reaction though is in the dollar. Look at what's happening with euro dollar. We are very close back now to that sort of parity line. As you can see, we're down